Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Null. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone. Welcome in. Welcome to Coasting in Retirement. That's right. Thanks for joining us today. We're excited to have you. I'm your host, Josh Null. And normally, this is a part where I would introduce my co-host. I'm normally joined by co-host Michelle Lee Melton, but I don't think Michelle will mind us sharing this with our listeners. We've obviously had great support with friends and family. She is currently at home recuperating from recent breast cancer surgery. So if you're listening, Michelle, we all are sending our prayers and our love your way. As you very well know, you got an army at your back, and you are a warrior yourself. It's very awesome to see how you've tackled this and moved forward. In her place, fortunately, I've got the greatest guest co-host replacement available on my speed dial, a guy that's been part of my life both professionally and personally for the past several years, and I would say has been crucial to my success, especially in the early years. So let's give a warm welcome to Mr. Jay Stubbs. Jay, how you doing?
Josh, I'm doing fine. Certainly glad to be back with you and helping you out in your business, talking with the folks here along the Gulf Coast. It's busy. It's a busy time of life. You know me, I've got 4 kids, got a senior this year.
It's crazy.
He plays football. He plays golf. I got 3 other kids. They're all over the place. Soccer, tennis, golf. It doesn't matter. We're always on the go. I like to tell people, Josh, that we are blessed, busy, expensive, but we do have fun at the Stubbs household. But things are good. Made a little work change.
Right. We're going to talk about that.
Yep. Made a little work change and still doing what we've always done, helping advisors and agents like yourself with your clients. But yeah, we'll talk about that later on. But all in all, just enjoying being, in the school year, in the fall, headed around the corner. Hopefully we'll get some sweater weather around the corner. Down here on the coast is a beautiful time of year in the fall once we get out of the 90s.
That's right. Well, it's great to be back in studio with you. Listeners, Jay serves as the Director of Gulf Coast for Providence Partners. And as we'll circle back to that later, that is a change for Jay. He was at many years at a certain place and now has, like everything else, sometimes you got to get uncomfortable to grow, and he's growing. So Jay and I, we're here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Now, if you're just tuning into our show, we want to welcome you. You're listening to what we consider Lower Alabama's most interesting and dynamic radio show, financial radio show. And what do we mean by that? Here's what we got in store for you today. Our first segment is a deep dive on our topic of the day. Our second segment, it's about 20 minutes past the hour. It's fan favorite, normally called Michelle with the news of the week, but with Michelle not being here, we'll just call it news of the week. Jay and I are going to go back and forth on that. Third segment, roughly 40 minutes past the hour. Again, normally called Josh's Crystal Ball and Big Mouth, but without Michelle here to poke fun at me, what Jay and I are going to do is we're going to go way back in our Every Dollar Counts podcast catalog and look at some of the things we've said that were both right and wrong over time. So anyway, the main thing is buckle up. We've got a lot to get to. Quick background on me for those, again, of you new to the show. Again, my name is Josh Null. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That's an independent investment management and financial planning firm. We've got offices in Fairhope and Orange Beach. You can find more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime at 251-327-2124. Now, if you just missed that, don't worry about it. We will repeat our contact info several times throughout the show. Also, one last little thing before we get on with the show, quick housekeeping for compliance. Jay Stubbs and Providence Partners are not affiliated with Prime Capital Investment Advisors, Qualified Plan Advisors, or Gulf Coast Financial Advisors. And me, Josh Null, I'm not affiliated with Providence Partners. So, Jay, as we laid out in our opening, the point of Coasting in Retirement, this show, is to discuss financial topics related to relevant to folks in or near retirement. When you and I discussed what we thought would be one of the most important topics that we could talk about while you were here, I feel like we both landed in long-term care pretty quickly. So today, listeners, Jay and I are going to discuss in detail the things you need to know about long-term care, sometimes what's called an extended healthcare event. And then we're going to give you some practical ideas and concepts to help you handle what many believe can often be the greatest destroyer of wealth known to a retiree. Before we get into all that discussion, what I'd like to do, because Jay Stubbs is new to you all, hopefully you got to know me a little bit, we're going to talk about Jay and I's bona fides for why you should listen to us giving our opinion about long-term care. Jay, tell folks a little bit about yourself, if you don't mind.
Sure, Josh. I've been in the financial services industry, specializing in risk, so all things life insurance, disability income protection, and long-term care insurance planning for almost a quarter of a century, 24 years and 6 months this summer. So 25 years next February. I am a chartered life underwriter. That's a designation, CLU. When you go through that self-study curriculum and sit for the exams, a significant portion of that is all the ins and outs of the long-term care insurance planning. In addition, the state of Alabama, our friends at the Department of Insurance, they require us to, every 2 years, get updated on continuing education specific to long-term care insurance. So anybody that's in the business of assisting their clients or has a client or a book of business, those folks also need to have their LTC continuing ed, but having 25 years of experience dealing with every type of insurance planning solution, if you will, for long-term care, and having transacted hundreds of solutions for different types of clients around the Gulf Coast, I do consider myself pretty well qualified. You and I have had many discussions through the years of, hey, Jay, I've got a couple, or I've got a gentleman, or I've got a lady.
Right.
What are we thinking that might be a good solution for them? In fact, just today, I had a 51-year-old female friend. She came in and said that she is very interested in trying to figure out what she needs to do for some sort of planning in long-term care. What if something happens to me? Obviously, the worst is passing, dying prematurely. The second is, what if I have an extended healthcare event, just like you just said? So day in and day out, conversations with advisors and agents like yourself with their clients in mind, discussing the long-term care. At least 3 to 4 times a week, this topic comes up, and it continues to grow each and every day. Just a lot of people aging, a lot of the baby boomer generation trying to figure out, golly, what are we going to do? Should I pay for this out of my own pocket? Should I go and talk to an agent or my advisor or another financial service professional about what we can do? Those types of things are important. We want to have conversations, and we want to educate people on what their options are.
So let's talk about this, Jay. I want to cover 3 things in this opening segment. So we're going to touch on them lightly, if you will, and then segment 2 and segment 3, we'll get to circle back and dive in a little bit more. But first, the need for long-term care. As we already discussed, there's probably plenty of people listening right now. They're already shaking their head like, yes, I'm glad you guys are talking about this. It's something that has been on my mind. I need to at least have a conversation around that. If you had to make the case, and maybe you make the case using stats, I don't want to get too nerdville, if you will, but what are some of the stats in general that folks would need to know about long-term care and why it's so financially impactful?
Well, the number one stat is we are living longer, and the Administration for Community Living, you can look that up at singlecare.com if anybody wants to go and look this up. Administration for Community Living tells us that 70% of those age 65 or older are going to experience an extended healthcare event.
Wow.
70%, so 7 out of 10, aged 65 or older are going to experience some type of long-term care event where they need to address it.
Right.
Again, they can address it and maybe have a short-term situation. Maybe it's a hip or a knee or something where their activities of daily living, which we'll discuss in just a little bit, it's going to be recuperated in maybe 6 weeks or 8 weeks or a few months. Then they're back up and running. But if that turns into an extension, think about some of the things that we can contract that take us out of the ballgame for a long time.
Right.
Cardiac events, cancer events, cognitive.
Breaking a hip when you're older.
Breaking a hip when you're older and you just can't recuperate.
Right. You just cannot recover.
And then the cognitive issues, early onset Alzheimer's, traditional Alzheimer's, dementia, those types of things come into play as well. But that's what we talk about. So 70%, if you're getting close to 65 or you're over 65, the likelihood statistically of having an event is high, 70%.
Well, and also what we'll do, Jay, as we progress through the episode, we'll also talk a little bit about the costs associated. There's a lot of information out there that allows you to get pretty hyper-specific on the averages in your area. I can tell you that if you ever do take the time to look, more often than not, you will not be pleasantly surprised. It will go the other direction.
Well, and that's true for a fact. Also, something to consider is every day we've got our baby boomer generation, a very strong generation, that they are continuing to age. In 2030, 10,000 baby boomers a day, every day, will be turning 65 years old.
That's incredible.
So as that generation grows, so too does the likelihood of needing care. Right. Now, let's go ahead and give kudos to our medical community. Let's
Agreed.
give all of our friends in the healing world. They have prolonged our lives through their research and all the ailments that we can get involved in. So the cancer research, the diabetic research, the strokes, cardiac, all of that is really we can be in take a pill and everything gets fixed.
Right.
It used to be several decades ago that if you had an onset of something in that nature, you're counting your days, your weeks, or maybe even your years.
Dealing with what Michelle has gone through, it brings back memories of being a kid, and you would hear about ladies that got cancer, and a lot of times they didn't find it till it was way too late. So yeah, you're right. It's progressed in many ways. The trade-off, as you already mentioned, is sometimes we live longer and not necessarily healthier, right? So let's do this, Jay. Let's pivot to, I want to talk about the different types of insurance products available to handle long-term care. We're also going to touch on Medicaid and Medicare a little bit. But before we dive into those, you just mentioned it, activities of daily living, because we're talking about breaking hips, we're talking about things like that. What comes into an insurance policy that's going to trigger somebody claiming a benefit or being able to make a claim?
So if you have a product out there, and many of you listening may have something that you bought years ago and you've got it taken care of, great. In order to file a claim on that policy, or if you end up purchasing something, you've got to be able to qualify for the benefit. To qualify for the benefit for long-term care, you need to not be able to perform 2 of 6 activities of daily living, or ADLs, 2 of 6 activities of daily living, or cognitive impairment, which we've already mentioned could be an Alzheimer's, dementia type of situation. So if you can do all 6 activities of daily living, but a physician has said, you've got early onset Alzheimer's or dementia, then that would also trigger a benefit.
Well, and you've got a great way to walk through the ADL. So let's walk the listeners quickly through how you help people remember it.
Absolutely. It's really easy to remember when you think about what's the first thing that you do in the morning. If you're laying in bed,
right?
You get up. Yep. So the very first thing that you do, whether you get up out of bed or you get up out of the recliner that you slept in all night, you have to be able to get yourself up. The next thing you do in the morning, most of us head off to the bathroom and use the restroom.
Yes, I usually stub my toe first.
So
after a stubbing toe, I go to the bathroom.
We definitely want to get up out of bed or get up out of the chair and be able to get ourselves over to the restroom. The next thing we do in the morning is we shower or bathe. We get ready for the day.
Right.
So you got to be able to bathe yourself, shower yourself. That's the third. The fourth is after you get out of the shower, you're putting on clothes. You have to be able to clothe yourself. Right. One leg at a time, pants, shirt,
things we
buttons.
take for advantage. Right.
Definitely take for granted. So being able to get dressed. The next thing we do is we usually head downstairs or upstairs, depending upon your situation, or across the house. We head to the kitchen and we fix ourselves breakfast and we sit down and eat. So you have to be able to feed yourself. So now we got get up. We've got restroom, shower, bathe. We've got get dressed. We've got transfer, being able to walk to and from point A to point B. Now we've got 5, right?
So we got one more.
Yeah. Now we get in the car. Maybe we head off to work, and now we've got the traffic jam on
Big
the Bayway.
Cup of coffee.
Yeah, we got the coffee. We've had the breakfast. Now we're in the traffic jam on the Bayway, headed over to Mobile County or headed over to Baldwin County, and we're going, that 6th one is continence. Being able to hold our movements in, whether we have to use, if we have to use the restroom, being able to hold that. Right. That is an activity of daily living, which is, that's, remember, 6 of them, that's 2 of the 6.
Yeah,
if you
2 of the 6 to trigger.
If 2 of the 6 cannot be handled or performed, then your primary care physician says you're in long-term care mode.
Understood. All right, so we talked about triggering the long-term care. as we wrap up segment one, let's talk about, you mentioned some listeners may have their own long-term care policy. What a lot of people don't realize if they haven't checked on the industry in a long time is the industry, I would say, Jay, I met you 9 years ago. I would say that was kind of the beginnings of a really robust growth and change of offerings that feels like it's really matured over the last 5 to 10 years, if you will. So there are more ways than just quote unquote traditional long-term care. So we just talked about what it would take to actually use a long-term care policy. What are the different options? I think there's 4. What are 4 type of insurance or 4 ways to pay for long-term care?
So there's 4 ways to pay. We're going to say that there's 3 product solutions from which to choose. The first is some people will use the terminology self-insure. Mm-hmm. It's not insurance if you're self-paying out of your own pocket. It's self-pay.
It's self-pay.
Yeah. So if you look at your account balances, your assets, the money that people are managing for you, your savings, your cash value life insurance, if you add all of that up and you've got enough money in your savings accounts, your retirement accounts, and your portfolio, and you've got income coming in, you can then run the risk analysis of what is the cost going to look like in my area, Mobile and Baldwin County. What's that cost going to look like today? What's it going to look like 15 years from now? We can then run some easy models. Josh, you've done this for folks.
I have, yeah. Part of our planning offerings.
Today we need about $5,000 a month if we're going to be in a facility, assisted living or nursing home care, so about $60,000 a year. If that is something that you have the means to take care of, then certainly you can be in a self-pay arrangement.
Yep.
However, there are 3 products that an individual or a couple could look at as a solution instead of...
Well, because some people can't self-pay and some people choose not to.
Well, some people can't self-pay, and the ones that don't want to self-pay understand leverage.
There you go.
They understand insurance, and they understand why I pay for it out of my own pocket when I can pay a small premium today for a large benefit 10, 15, 20, or 30 years from now, and I can have an insurance company take care of these bills for me.
All right, let's talk about that path.
The first in that world, so this would be number 2 on the solution grid. First was self-pay. Second is traditional long-term care coverage. A traditional policy looks and smells just like a homeowner's policy, just like a car or an automobile policy. You pay a premium. You're insuring your body. And remember, Josh, there's 2 ways to calculate risk, and the way that these insurance underwriters price it. There's longevity risk, and then there's that's where long-term care comes into play, and then there's living risk. Technically, it's mortality
and morbidity
versus morbidity.
Yeah.
Right. So mortality is we're going to die.
Right.
How old are we? What's our life expectancy? Morbidity is our body. What have we done to our body? Gosh, you've beat yourself up on the basketball courts.
I have. My knee fell off my leg a few years ago. Yeah.
So you've got more morbidity issues. An insurance underwriting company is going to look at that and determine your longevity with respect to your morbidity.
Understood.
So basically, layman's terms is, are we going to have to take care of this person because they're not going to be able to function down the road? Right. They're going to see what medications they're taking. But you can get a traditional long-term care policy, just like an auto policy protects your car. A homeowner's policy protects your home. A traditional LTC policy protects your body. Also, it protects your cognitive function. And again, it goes back to if I buy that traditional, I'm paying a premium, monthly, quarterly, semi-annual, annual, whatever. I'm going to buy a pool of money. That pool of money is going to come to me in a monthly benefit, and that monthly benefit is going to be limited in duration, anywhere from 2 years to upwards of 6 years.
Right.
So I can buy 48 months of coverage, or I can buy 60 months of coverage in a traditional contract or a traditional long-term care policy. Right. That benefit amount is determined, your duration and your benefit amount helps them, and your age helps them to figure out what your premium is going to be.
All right, so let's pivot with this. Let's say I buy that said policy, then I just drop dead. I'm in a car wreck.
Yeah, well, just like if you never have a homeowner's claim and you pass away, you don't get any premium back for that homeowner's policy. And that's
Nor do you get a benefit.
Nor do you get a benefit.
All
if
right.
you never have a car wreck, but in the state of Alabama, you've got to have the coverage. If you never have a car wreck, you never go on an automobile claim, so you never get it. If you die with a long-term care traditional policy, your beneficiaries, your family get nothing. You've paid for it. It's a use it or lose it scenario.
Understood.
Now, it is the least expensive
agreed,
of
right.
all the solutions out there. However, I will say this, limited duration, limited benefit, that sometimes can make people a little uneasy. not being able to have something beyond that 5 or 6 year time frame. Also, that policy is a rate that could potentially go up.
Right.
So you might, and again, these companies are good companies, but we've already addressed it in this radio show. People are living longer. That means their claims experience is getting heftier and heftier each and every year. So sometimes a traditional long-term care policyholder might get a rate increase letter. If anybody listening has ever had that, you'll nod your head. Yeah, okay, we had to make a decision. Do we keep the same benefit, pay a higher premium on a monthly or an ongoing basis, or let's keep the premium the same and we'll drop the benefit amount down? So they do have options when they get that benefit increase letter. It's not insurance companies cannot guarantee that your premium's never going to go up in a traditional long-term care contract.
Well, let's talk about, so I mentioned in the beginning, there's a lot more dynamic solutions now. Let's pivot to something you touched on quickly or briefly was asset-based long-term care and then hybrid policy. So let's talk about an alternative to the situation you just laid out.
So if you want something that's going to last longer than 5 or 6 years, and you want something that if you never use it, you want your family to receive some sort of benefit when you pass away, you can use an asset-based solution. So this would be number 3 on the matrix, if you will.
Okay.
First was self-pay. Second was traditional LTC. Third is an asset-based solution. This is where I'm going to pay a single premium. Maybe I'm going to transfer money from a CD or an old annuity or maybe a life insurance policy that I don't need anymore. I'm going to use that cash value. Or I've just got money sitting idly in an investment account that I've got, it's sitting in a money market and it's not really doing anything for me. Well, those are the assets that you can reposition in an asset-based solution. And a healthy individual can reposition that asset. So it's like moving money from one pocket to the next. And they still have access to that cash, but they've leveraged it anywhere from 3.5 to 4 times in a bucket of money that they can use for long-term care. That asset-based solution, there's a company out there that you can also add a rider in what is called continuation of benefits, and as a lifetime guarantee rider. So you can plop a single premium bucket of money. You can get leverage 3.5 to 4, sometimes 5 times, depends upon your age and your insurability. You can structure that over a period of time to get the same thing as the long-term traditional. You can do 2, 3, 4 years, but you can add a rider. And that rider says, I'm going to have a benefit for the rest of my life.
Okay.
Couple of nuances to an asset-based solution. There's a couple of companies that you can now look at, and a married couple or partners, they can have that type of planning for themselves. They get not only a couple's discount, but they can draw from the same pool. One of them can be on claim or both of them can be on claim. So that is a unique feature of asset-based. Some people may be saying, well, what if I don't have the asset to reposition? What if I don't want to just dump one time a bucket of money in there? Well, they can structure it in an asset-based solution to do a 10-pay. They can do a 20-pay. They can do a pay to 65, or they can pay to 95.
Well, in the 10-pay, listeners, that means you pay it typically over 10 installments, typically annually.
Yes.
Right. Yeah. You have a structure.
So instead of single premium paying it in year one, you just take that amount, divide it by 10, and you pay that over a 10-year period.
Okay.
Some people they're still working. They want to have a solution. They don't expect to have income stopping. They can do a 20-pay. Or if somebody says, you know what, we just want to do this for a lifetime pay, they can set that one up as well.
Okay.
That is the solution. The asset-based LTC solution can also look at qualified money. So if somebody's got a large qualified plan balance, 401k, IRA, they can reposition those dollars and look at qualified transfer of wealth and establish a long-term care plan. Those asset-based solutions, if they never use it, they have a death benefit that is paid back to the beneficiaries that they designate on the policy.
Yeah, direct contrast to the traditional.
Income tax-free.
Right.
Income tax-free. Yeah, so traditional has no death benefit or residual that goes back to the family. And asset-based, if you never use it, does have a residual or a benefit that comes back to the family or the designated beneficiary.
Okay. Well, you mentioned life insurance. We got one more type. What is the final type of product? Yeah,
so about 15 years ago, a lot of the traditional life insurance companies on their universal life portfolios, their whole life portfolios, they designed what is considered extended care riders or long-term care or chronic illness care riders. So you can have a traditional life insurance policy and you can add a rider that will also serve as a benefit should you need to go on claim with those 2 of 6 ADLs or that cognitive situation. That's for the folks that still have maybe a large mortgage on the home. Maybe they're business owners. They still have lines of credit that they want to protect against on premature death. So they have a dual purpose. They still have a life insurance need, but they can also now get a life policy coupled with a rider that has a long-term care bucket of money that they can tap into should they need it.
Very good. Okay, so quickly, those 4 things, the 4 ways were self-pay. Some people refer to it as self-insured, but self-pay. We got traditional long-term care policies. We got asset-based. And then we have a rider hybrid, if you will, a rider on a life insurance policy, right?
That's right.
Okay. So listeners, if you've been considering having a conversation about long-term care, particularly if you want to see how it fit together in a comprehensive financial plan, then I encourage you to reach out to us. Now, what does that mean, reach out to us? Jay and I do not work for the same company. He is an advisor to advisors like me. And as you listeners just heard, deep depth of knowledge, not just on long-term care, but that's our topic of the day. He is available typically to join us, Zoom, phone calls, sometimes in person if the schedule works. If you've got a really in-depth conversation you want to have about long-term care, Jay's a great resource to me and the team at Gulf Coast Financial Advisors and to other advisors in the area. I'm selfish, but not that selfish. So if you all want to continue that conversation, what I'd encourage you to do, go to our website. You can go to our calendar link. It's in the upper right-hand corner. That website was gulfcoastfa.com. That's Gulf like the Gulf of Mexico, Coast as in the show title, FA as in financialadvisor.com. Or you can simply call 251-327-2124. Either way, we'll set up a no-pressure, totally free, no obligation conversation with us. It can be about long-term care because that's the point of this episode we're having here. But also, as you know, we're comprehensive financial planners and financial advisors. We can talk about all of these things as it relates to helping you with your investments and your risk management. All right, folks, coming up next, every week we scour the interwebs for helpful financial articles related to our topic of the day, especially articles related to those of you in or near retirement. So what I want you to do is join us after the break. You're going to hear Jay and I discuss this week's relevant headlines in our News of the Week segment. Stay tuned. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back to Coasting in Retirement. Your host, Josh Null here. So as we discussed before the break, every week we scour the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Our job, at least we think it is to help you all understand how these headlines impact you, especially when it comes to your money. So now normally, Jay, Michelle would read the headlines and I would react, but in her absence, we're gonna switch it around a little bit. I'm going to read the headline, and then we're going to discuss. Let's get your reaction, and then I'll discuss off that, okay?
Sure.
So without further ado, I guess here's Josh with the news of the week, not Michelle. All right, so first up, Jay, referencing Michelle again. She is a creature of habit, and typically she pulls her headlines from sources such as Investment News, CNBC, Forbes, Kiplinger, Barron's, Bloomberg, names you recognize, right? So I had asked you to maybe find a few news headlines that you wanted to discuss. And in doing so, you found a site that we haven't referenced before. In fact, I'd never heard of it before. It's called Farm Forum. Do I have that right?
That is right.
Okay, so Farm Forum, Sounds like something back home in Missouri that my peeps would read.
Well, it's all your ag news and farmers. They log on to this place and they read about stuff. I mean, farmers.
That's fair.
Farmers write articles about different things and advisors to them. So it's Farm Forum.
There you go. Well, they have a fresh off the press article titled, quote, "Why We Put Off Planning for Long-Term Care." Now, end quote. This article talks about some of the cognitive biases that keep so many people from addressing their long-term care planning needs. And these are things, some of it was surprising. Some of it was like, oh, well, no kidding. The obvious bias of procrastination. I showed some procrastination when preparing for the show, but here we are. What I liked about the article is it goes a little deeper on the underlying reasons why we hesitate to plan ahead. So, Jay, if you don't mind, what I'd like is you to give us your thoughts in this article and maybe how to help people overcome their own inertia when it comes to long-term care planning, because it can be uncomfortable.
I'll speak from experience, but it also says this same stuff in the article. When sitting down with a couple or an individual, especially a healthy male, the very first thing that say is, it's not going to happen to me.
100%.
No, the optimism exudes. So this article references the optimism. Oh, I'm really healthy right now. My family, my mom and dad, they lived a really long time. They've never experienced any of the big medical setbacks, cardiac cancer, stroke, diabetes. I'm just really, really healthy, and the likelihood of me needing a plan is very, very small.
Right. I'm bulletproof.
Yeah, bulletproof. But when you reference the 70% age 65 or older, that's the research, that's the real number. 7 out of 10 folks are going to experience some sort of long-term care event. So the optimistic person listening to this show, that's what one of the items in the article references is, hey, it's not going to happen to me.
Right.
Well, that's great. What if it does? That's the next thing that happens when somebody says, well, I don't need a plan. Well, without a plan, the
failure to plan is planning to fail.
That's right. So we will sit down with those types of optimistic folks and say, look, do you want to be a burden on your kids? Where do your kids live? Are they here in town, or they live, hours and hours away? Are they across country? Are they in the Midwest? Are they up on the East Coast? If something does happen, who's going to come in and assist?
Right.
Who's going to formulate that plan of care?
Right.
So the optimistic person, or the person with pretty decent means, meaning the financial means, sometimes they just understand, oh, well, if it does happen, I need a plan. I want a plan of care, and I want to have this in writing so that I can comfortably and tell my kids and my loved ones, this is what we're going to do should something happen to me. What's really unique about a lot of these long-term care insurance companies, the traditional, the asset-based, the life with a rider, you get a care consultant if you go on claim.
Truth.
That care consultant is a very powerful tool in the toolbox, not only for you and your immediate family, but for any extended family. They help find the right place. They help find the right skilled nurses to come to the house if you want to stay at home. They help position and make a reservation for a bed or a room at any of the assisted livings or nursing facilities that we need to go. And those places are packed.
Right.
And if you want to end up in there, you got to make a plan to get there. So the optimistic person, okay, let's say you make it and never have to worry about it. These types of solutions we bring to the table, your family's going to get something back.
Well, that's what I was going to pivot. Even the most optimistic person that says they're bulletproof realizes that they're going to pass at some point.
That's right.
Yeah, we're going to pass. Well, very good. All right, Jay. So next up, CBS News. This feels weird to sit in Michelle's seat. Another very recent article. CBS News asked, quote, "When should I buy long-term care insurance?" End quote. Now, Jay, you and I have had some experience around this question. It's something that definitely gets asked a lot. And I'm going to point out a major figure in our industry that most people are familiar with, Dave Ramsey. And as I've done a handful of times on this show, to kind of make a point on answering the question this article poses, I'm going to politely push back on some of what Ramsey says. For example, I think Dave Ramsey's done a great job of convincing most people that they need to at least look at long-term care insurance at some point, but he pretty consistently encourages people to wait until they're 60 or older to start looking. I don't agree with that. My personal belief, and this is where I'm tossing it to you, is I hold that traditional long-term care and long-term care in general, the underwriting has gotten a little stricter over the years. And if you're waiting until you're in your 60s, you may be waiting until you have an uninsurable condition. at the very least, you should at least check out your options in your mid-50s. That's my opinion. So let's pivot back from my opinion to this article. When do you think, Jay, that someone should look at, maybe not buy it, but at the very least investigate it? And do you agree with some of the decision factors listed in this article?
I'll be 47 in February, and I've already started investigating it.
Yep.
Now, I'm in the business, so I understand the importance of the investigation. However, I do recommend that people start thinking about it once they hit 50. If you're in your early 50s, that's a good time to start thinking about it, evaluating it, whether you want to do traditional or asset-based or life with a rider. Start having a conversation with your advisors and your insurance professionals once you hit 50, because there's two things that you have in your favor in your 50s: affordability and eligibility.
Okay.
The article references affordability. It's still an affordable planning premium when you're in your 50s. As you get older, those premium, especially in the long-term care traditional product, that premium creeps up each and every year you get older. So affordability comes into play. You can get more bang for your buck when you are in a younger issue age. The second part of it is eligibility. Think about if you're listening to this, think how many people you know 60 or older who are in absolute perfect health. If you're in absolute perfect health listening to this radio show, that means you take no prescription medications, you've had no serious bouts or illnesses, you've had no surgeries, you've broken nothing. You are a picture-perfect specimen on this earth. Congratulations. But now think, how many of those do you know that are 60-year-old or older?
I don't even qualify.
No.
I mean, there's nobody on earth going to insure my knee.
So eligibility is a big reason to start looking at long-term care early on. So 50s is a great decade to kind of get a lot of planning done, but specifically starting to research and figure out, is long-term care planning something we want to do? And if it is, let's go ahead and take advantage of it, start getting pricing, start looking at all of our options, because you want to give yourself time. And that's the third point in the CBS article online, is adequate planning time. Give yourself the time while you are thinking about it to make the plan, put everything in writing, get everything to the kids, whether they're in town or across the country. Make sure everybody knows there's a plan in place, because without a plan in place, we're planning to fail.
I like it. So, Jay, I'm going to skip to our last article. Now, this one is from, again, one of Michelle's favorite sites. It's Smart Asset. She calls them Smart Alex. But so Smart Asset asks the question, what is asset-based long-term care? And here's why I want to jump to this one, because we had just a couple minutes to discuss asset-based long-term care in the opening of the show. I'm going to give you my opinion, then I'm going to ask the question based around this article. I do see people still purchasing traditional long-term care policies. That does happen, right? Particularly because, generally speaking, if you buy relatively young, it's reasonably affordable, right? But as you very much alluded to, it works just like auto and home insurance. There is the danger that you may not use it, so you paid these benefits for years. There's the danger that the premium will increase, and I can tell you historically, if there's been any certainty in the traditional long-term care industry space, it's been creeping insurance premiums. I think that's a fair statement, even though they're very well-run companies. Like you said, when 10,000 baby boomers are turning 65 years old, the odds are against you on accumulate or managing all that. And then I think also, just as we discussed, you're going to have a limited benefit period. Now, so let's pivot back to this article, Smart Asset. Of your many areas of expertise, I feel like you have as firm a grasp on this part of the industry as anyone. You're the one that introduced me to asset-based long-term care options. So would you mind to walk our listeners through kind of like an example, an asset-based long-term care, and an ideal fit, where the option's available? How does that look? Because to me, it is a great way. Obviously, you've got to have either the like you said, Jay, you got to have a bucket of money set to the side, or the ability to build that bucket of money over a specific time period. But I think once you have that, it's a great way to hedge your bet both ways. If you end up needing long-term care, here's a leveraged up bucket of money. If you don't, if you go out in a blaze of glory, heart attack, like old, what was that, what was his name, that guy from Sanford & Son? I'm coming to see you.
Fred Sanford.
I'm coming. If you go on a blaze of glory, then your heirs get a benefit. So I'm going to toss that to you. Asset-based long-term care as we close this segment out.
Sure. So in all the almost 50 companies we have access to, we have one legit solution as traditional. We have 5, possibly 6 in an asset-based.
There you go.
So not only are we kind of stuck in the traditional world. But if we pivot to an asset-based solution, we can go and price different products and compare and see which one is going to be a better fit for a client or a couple. So an asset-based solution, there's just more of it out there. There also are some bells and whistles that we get with an asset-based solution that we don't get with traditional.
Okay.
The bells and whistles are we have a benefit that will be payable to our beneficiaries should we not use it. That is a very attractive offer for the asset-based solution. If I need access to the cash that's sitting inside of this product, I still have access to it. Think about it from like a rainy day fund or an emergency savings account. We don't encourage people to put money in and just go in and out with the cash. We want to be able to put it in there and let it do its job.
But there is a cash value component.
There's a component where that individual or that couple, if they need access to it for an emergency, they can certainly get it. When I keep mentioning couples, there's a joint life option. That is really, really important. We have 2 companies of those 5 or 6 that allow for a couple, married couple, to come in there and have a benefit together. And that's a great feature. One specific company says you can share in the pool of money. You buy one pool. If husband goes on claim, and then 3 years later, wife goes on claim, both can be on claim at the same time.
That's fantastic.
And if you remember, we added in a rider. That's another bell and whistle. We can add riders to these policies that can give us additional benefits and additional extensions of coverage.
Very good.
So the asset-based solutions, I've said it earlier, it's like moving money from one pocket to the next and then leveraging that up.
Yep.
So when we can use it in a single premium fashion, 10 pays, 20 pays, pay for a lifetime, the asset-based solutions give us a lot more flexibility with additional bells and whistles. And somebody might be saying, well, golly, why is that such a good deal? Well, the asset-based solution, remember, you're positioning your money first. Then the insurance company is coming in behind you and offering you your benefits once your money is exhausted.
Similar to self-pay, but with leverage.
Correct.
As you mentioned earlier.
That's correct.
All right, well, great job. So listeners, if you have questions around this topic or any of our related topics, or just questions related to your investment strategy or your financial plan, remember, you can set an appointment. You can call us, 251-327-2124. I do my very best. We joke about this on the show, Jay, but I actually try to answer that phone every time. I want to know what's going on. Like my dad has always said, be worried when that phone quits ringing. So I try to answer it as often as I can. It's fun when people call from the radio show, so we encourage you. Give us a call. You'll talk to me more often than not. If you're a digital person, you want to set something up on the calendar, go to our website, gulfcoastfa.com. GULF, like the Gulf of Mexico, Coast, FA is in financialadvisor.com. It's on the upper right-hand corner. And remember, no matter where you set the appointment, it's free. There's no pressure. There's no obligation. All right, so Jay, coming up next, our next segment is typically called Josh's Crystal Ball and Big Mouth. You know, I get to pat myself on the back on some of my accurate opinions and predictions. Michelle, when she's here, she gets to bust my chops whenever my big mouth was off. But with you filling in for Michelle, I thought it might be fun to look back at some of the things that you and I have said in the past on our very popular podcast, Every Dollar Counts, with Josh and Jay. Now, don't worry, we were mostly right, but we did whiff on a few things, particularly me. So, listeners, join us after the break to hear Josh and Jay's Crystal Ball and Big Mouth. Stay tuned. Whether it's building a business from scratch with your own 2 hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA is in financialadvisor.com. Welcome back. Your host, Josh Null here, alongside guest co-host Jay Stubbs, filling in for Michelle. So, folks, I'm opinionated. I have strong opinions. As I've said before, a radio show host that isn't opinionated probably wouldn't be very interesting to listen to. Sometimes I feel so strongly about something that I talk about it publicly, the various podcasts and radio shows I've had. Sometimes I'll even make predictions, and while I feel like I'm usually proved right, there are times that I definitely swing and miss. And guess what? There's someone else here in studio that has often joined me in expressing these predictions and opinions. Again, on a wildly popular podcast we've had, Every Dollar Counts with Josh and Jay. That's right, Mr. Jay Stubbs himself. So, Jay, I went back through our Every Dollar Counts podcast catalog. I picked out a few of our predictions and opinions. I gave you no time to prep for this. So let's just see how right and wrong we were, all right?
Absolutely. Let's go.
Let's do it. So the first one I'm going to pick on myself just to make it fair. Get one of these bad predictions right off the bat. Back in July of 2022, we released an Every Dollar Counts podcast episode titled We're Living a Country Song, where yours truly said that it was nearly mathematically impossible for inflation to keep growing at the rapid pace we were experiencing at the time, and that I thought it would just be a few months until inflation eased. And now, this is Glenn, July 2022, right? Now, to be fair, apparently pandemic-related inflation actually peaked in June of 2022, which I just learned today, at 9.1%. So I wasn't totally off. But as anyone knows, we're still dealing with high inflation well over a year later, and the Fed funds rate is at a decades high, right? Also, last little fun piece in that article, or in that episode, Jay, we were referencing a Hank Williams Jr. country song. And in that song, it specifically says the interest is up and the stock market's down. It also says that the Mississippi River, she's a running dry. So maybe our crystal ball was right? These are all things that are happening. So anyway, back to our point, Jay. What are your thoughts about inflation moving forward? Obviously I swung and missed pretty badly back in July 2022. And and in your line of work, what have you seen the impact of inflation on the insurance industry?
Well, let's just first back it up. And we're at the Stubbs household with 6 mouths to feed, 2 dogs and a cat. I personally have seen inflation and items tick up. My son loves chocolate milk, and that's getting a few cents higher than I've ever seen before. You go and buy the good steak or the chicken. Fortunately, our good friends at our grocery stores do the BOGOs, and we can get some of our items a little less expensive than we normally have. But I personally have seen things creep up in our grocery costs. We've seen the fluctuations in our gas and our fuel costs. Just hearing friends in the construction business, golly, it's so expensive to build something these days. Or we thought construction prices would ease, but not the case. The cost of lending tied to the interest rate is driving a lot of that. We've got good friends at all the banks. They're sitting in situations where the money is expensive right now, and where you might be able to a couple of years ago be at 90% loan and expense. Now you're looking at something of a 60%. So it's a situation where the borrowing has gotten more expensive. We also know that our good laborers down here. Some people are moving on and figuring out other ways to drive some income because or finding other ways to make money. So they're doing other jobs and side jobs. The self-employed DoorDash driver and delivery person is finding out, you know what, I get to make this money and I don't have to worry about going into an office or a work environment. I get to make more money and not have all the headache.
Well, the gig economy to keep up with inflation.
Absolutely.
Right?
To keep up with the times, to keep up with inflation, we're seeing a lot more people maybe working a couple of jobs, maybe choosing to do just the gig job. It's amazing to me. But the flip side of the coin, things are a little bit more expensive. Absolutely. Things are a little bit more costly when we want to do a project. Yes. But if we're looking at our traditional savings account at our favorite banks and lenders, if we're looking at
nice interest rates,
we have great interest rates, annuity products that you and I have as available fixed rate products. Those rates are the highest they've ever been in probably 20 years.
All right, very good.
So those are the flip side of the coin. If our savings rates are higher because our interest rates are higher, but inflation has definitely crept in, and I do think we're going to see a continued strain on the economy into 2024.
All right, last one, Jay. This one ties our discussion about inflation together with our interest rates. Back in March of 2022, we had a Every Dollar Counts episode titled Interest Rates and Income Annuities. Now, fortunately, I didn't stick my foot in my big mouth. like I recently did on this show. A couple months ago, Jay, I had an episode asking listeners, is this as good as it gets with fixed interest investments? Yeah, I mean, I wouldn't even write for a week, but clearly it wasn't. But on our Every Dollar Accounts episode, you and I avoided any predictions in that episode. We were just focusing more on how a rising Fed funds rate was going to affect insurance products, particularly annuities. And Jay, you'll laugh, but back when we recorded that episode, the Fed funds rate was 1%. And
my gosh.
And we were talking about it rising. And now it's in a range. I'm rounding. It's in a range. Right now the range is 5.25 to 5.5. I know that seems silly, but that's how they do it. The thing is, it's set to possibly rise further. So my question to you, how has the rising interest rates affected the different class of annuities? I want to be specific, Jay. Let's talk about MYGAs, because our listeners, regular listeners, are familiar with MYGAs. They're familiar with fixed income. They're familiar with or fixed interest. And they're also familiar with deferred income. So let's just quickly talk about how interest rates have affected those annuities that you've seen.
Well, when the rates rise, so too do the opportunities for insurance companies to make money in their general portfolios. They're invested in a lot of interest-sensitive products. When their general portfolio does well, they pass those gains, if you will, off to the consumer in the form of a higher guaranteed interest rate.
Okay.
So the MYGA, the multi-year guaranteed annuity, you can get one 3 years, 5 years, 7 years, up to 10 years. We're now seeing those where we thought 3.5.
Oh my gosh. I remember I did one for 3.2 one time, and I thought I'd had a fat hog.
I keep my thumb on the pulse of those things, and there's 5 and 7 year guaranteed annuities at 5.6.
Right.
That is, ranging 5.4 to 5.6.
Right.
Each of them have different components of the contract that may be, that fit your situation better than another. But that is at 5.5. That's a very attractive rate of return on a product that's got your money just sitting idle, and it's going to accumulate. And then over a certain period of time, you walk away with that.
Very good. All right, so folks, I hope you enjoyed Jay and I's little stroll down memory lane of our Every Dollar Counts podcast. If you want to hear more from Jay and I, you can go check out Every Dollar Counts, the catalog on Spotify, or I still have it on my website, gulfcoastfa.com. And Jay, it's probably a little premature to announce this, but you and I are in preliminary discussions to bring the show back. This time we would probably look at doing an industry-facing type of experiment. That way we can help independent and semi-independent advisors and agents better serve investors like you all that are listening. But we'll see. The announcement to be made. Is that fair?
That's fair. I've worked with hundreds of advisors and thousands of their clients, so why not bring some of that knowledge to those that are coming up in the business?
Well, I think it's been pretty obvious through this episode what value you brought to my practice. Just having that wealth of knowledge. I've thanked you many times on there before, but I'll thank you once again. Sorry, back to our segment. Listeners, if you have more questions about this topic, we talked about long-term care today. If you have questions about your financial plan, your various investments, anything related to what we do, I invite you to reach out to us. Call us anytime, 251-327-2124, or you can always make an appointment on our website. You can also leave a message on our website. It's pretty cool. You can type me out a little message. Again, I get all this stuff. I pay attention. It's gulfcoastfa.com. Folks, that's it for us here this week at Coasting in Retirement. I want to give a huge thank you to Jay Stubbs, filling in as co-host for Michelle while she recuperates. A thank you to our awesome radio show station, FM Talk 106.5. Many thanks to the producer of our show music, local band, Sloth Racer. You remember them, Jay?
That's right.
And as always, my sincere appreciation to all of you out there that have been listening and joining us on this journey. We'd obviously love to be part of your financial journey as well. Till we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Null.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. Prime Capital Investment Advisors, LLC, 6201 College Boulevard, 7th floor, Overland Park, Kansas, 66211. Prime Capital Investment Advisors, LLC, doing business as Prime Capital Wealth Management and Qualified Plan Advisors, and Gulf Coast Financial Advisors are not affiliated. Gulf Coast Financial Advisors, Prime Capital Investment Advisors, Prime Capital Wealth Management, and Qualified Plan Advisors do not provide tax, legal, or accounting advice. This content has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. The information provided herein is not a complete analysis of every material fact regarding any strategy. It is intended only to provide insight into the opinions of the author. All information presented is for educational purposes only and is not an offer or solicitation for the sale or purchase of any securities. Content offers commentary and generalized research, not personalized investment advice, and is for informational purposes only and does not constitute a complete description of our investment services or performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified legal professional and/or tax professional before implementing any strategy discussed here.